All right, I'm going to do a few videos on some of the exercises in the back of chapter 17. There was one or two questions, so I just wanted to go over some of them to kind of give you a lowdown of how this works. So the first one is going to be 17-3. In my book, it's page 902. It may be a little bit different for you. But the first one is we have all of these materials, and we want to go ahead and journalize or record the transactions, put it to raw materials, and then determine the ending balance in raw materials. So raw materials is the very first inventory account that you're going to have. It's you buy, when you're a manufacturer, you buy the raw materials, and then you start making things, which goes into work in process, and then finally it goes into finished goods. So let's go ahead and see how we're going to make these journal entries. I'm going to pull up Excel here. So the first thing we want to do is figure out how much in raw materials we purchased. So we have 65,000 of canvas on account. So on account means we just haven't paid for it yet. And then we have sewing machine lubricant oil, again, on account, we haven't paid for it yet. So 65,000 for the canvas, 1,000 for the oil. So we have a total of 66,000. So I'm going to call that raw material inventory. If you just called it inventory, that's okay. I'm going to debit that for 66,000 because my raw material is going up. And it said on account, we haven't paid for it yet. So that's going to be accounts payable. So the next part of this is how much went from raw materials into work in process. And we can see that whoever is building these things, making them, requisitioned or asked for these materials from raw materials. They asked for 63,000 in canvas and 400 in sewing machine oil. So I'm going to take 63 in canvas, 400 in oil, and move it from raw materials to work in process because that's the next step. So we're just going to take work in process, and that's going to be inventory. Total of 63,000 for the canvas. Now, the next one is going to be manufacturing overhead. And let me explain that for a second. Manufacturing overhead are any of the indirect materials that you are going to be using. So if it's a direct material like this canvas, you're just going to put it in work in process. If it's indirect, like oil, then you're going to put it in manufacturing overhead. So again, direct, easy to count. You know exactly how many you're using. Direct material, it goes in work in process. Indirect material, not so easy to count. It goes into manufacturing overhead. And that's all coming from our raw materials. So we're going to go ahead and lower our raw materials. Oops, this is 400. So I'm going to lower my raw materials by 63,400 because it's going from raw materials and it's going to, we're either going to split it into work in process or manufacturing overhead. Work in process is direct materials, and overhead is going to be indirect materials. Okay? The next one that I want to talk about is labor. So we just did materials. Let's go ahead and talk about the next one and sort of the trifecta of manufacturing costs of labor, overhead, and materials. So let's talk about labor. So in this one, we want to have labor-related transactions. Now, again, we have direct labor and we have indirect labor. So direct labor are those people that are easy to track. We know exactly how long they worked on each object. We can trace their labor directly to whatever they're making. Indirect are those people that we know still need to work there, but you can't necessarily trace a certain hour to a certain thing that you're making. So janitors' wages are going to be indirect. The plant furnace operators' wages are most likely going to be indirect as well. Janitors, you cannot trace their hours to a particular item that you're making, I guess a particular vase or whatever it is. Plant furnace operators' wages are pretty much the same. It's very difficult to trace how many hours they have worked on a particular vase or whatever other glass that they're doing. Now, glass blowers' wages, however, are very easy to trace. They know exactly how many hours they worked on a vase or whatever else that glass manufacturers make. So we're going to have indirect for janitors, indirect for plant furnace operators, and direct for glass blowers' wages. So let's go ahead and journalize that right now. So we have work in process. Now that is going to be, and that's again inventory, that is going to be our direct labor. So that's our glass blowers labor cost. And then we're going to have manufacturing overhead. Same thought process as with the materials. Direct goes in work in process, indirect goes into manufacturing overhead. So that's going to be the janitor and the furnace operator. So I think that was a total of $1,500. And we have not paid them yet, so that's going to be wages payable. However, it didn't specifically say that, so if you credited cash here, that would be fine as well. The next one I want to talk about is 6, accounting for overhead. So let me scroll down. So in this case, we need to determine what's going to be direct and indirect, because again, one goes into overhead, manufacturing overhead, and one goes into work in process. So let's take a look at what we've got going on here. So we are a manufacturer of pianos, and we have all of these accounts here. So before we even start, let's go ahead and determine which is which as far as all these accounts. So wood, I would say wood is going to be direct material. That's not going to be overhead. Nails, glue and stain. And those are items that are still going to be materials you're going to use, but is it going to be easy and cost effective for you to trace how many or how much you use for each piano? My guess would be no. Depreciation is going to be on the saws. So as long as the depreciation is going to be on the saws, it's something that you're using in the manufacturing area, you can go ahead and put that into manufacturing overhead. Indirect manufacturing labor, that tells you right there, it's going to go ahead and be an indirect cost. Depreciation on delivery trucks. This gets a little bit tricky because the depreciation on delivery trucks don't have anything to do with the manufacturing process. They have to do with the delivery process. So they're not even going to be included in the manufacturing costs. And then as far as assembly line workers' wages, those are manufacturing costs, but they're going to be direct labor. They're not going to be indirect labor. So let's go ahead and journalize and figure out what we've got going on here. Okay. So the first thing that I'm going to talk about is our manufacturing overhead. So let's see what we've got going on for manufacturing overhead. So we have determined that as far as materials, we know that this, nails, glue, and stain is definitely indirect materials. So let's go ahead and journalize that. So that's 17,000. And where does it come from? It's coming from raw materials. So I'm going to lower my raw materials. Okay. The next one is, let's go ahead and talk about our depreciation. So we have depreciation on our saws. That is part of the manufacturing process. So let's do manufacturing overhead. 4,900. Now, instead of it coming from raw materials, when you make a journal entry for depreciation, typically it goes into accumulated depreciation. And what else did we have in overhead? So we had the indirect manufacturing labor. So that, because it's indirect labor, is going to also go into manufacturing overhead. And that was 37,000. And let's assume again we haven't paid for it. If you put cash here, that's okay too, because it didn't specifically say. 37,000. The next one that I want to talk about is 8, because we're going to figure out our predetermined overhead rate. So with 8, we've got 96,900 in total overhead costs, and we're going to allocate it based on direct labor. So all I'm going to do is I'm going to take my total overhead costs and divide it by my total cost driver. In this case, we've determined that it's direct labor hours, and that's going to give us a predetermined overhead rate per direct labor hour. So I'm going to take 96,900, divide it by 5,100. So that gives us 19. What that essentially means is for every direct labor hour cost that we incur, we are also incurring $19 of overhead. So if that's the case, and we have $19 in overhead costs for every direct labor hour that we incur, and we incur 4,400 direct labor hours, I'm just going to take 4,400, multiply it by 19. That means that we've also incurred indirect costs of 83,600. Keep in mind that this is just an estimate that a company will make at the beginning of the year. So they make their predetermined overhead rate at the beginning of the year. They allocate it based on, in this case, direct labor hours. Well, then you get your actual indirect expenses in. You get your actual indirect labor, you get your actual indirect materials, and you're going to compare that to what you had allocated at the beginning. So we had determined that if we work 4,400 hours in direct labor, we're also going to have 83,600 in indirect costs. Well, what happens if our indirect costs actually amount to $90,000? Well, we didn't do a super good job of estimating what our indirect costs were, and we're going to have to make an adjustment for that at the end of the year. The same would go if we had $80,000 in indirect costs. Well, we did a better job of estimating, but this time we overestimated instead of underestimated. So we'll still have to make an adjustment for that at the end of the year. So as far as the adjustments go, what we're going to do is if we underestimated, let's say our actual costs were $90,000. So we underestimated by 6,400, we're going to have to increase our cost of goods sold. So we would debit our cost of goods sold here. If it was the opposite, then we would decrease our cost of goods sold with a credit. The other side of that, of course, would go to manufacturing overhead. So if you are increasing your cost of goods sold, you are crediting your manufacturing overhead. You still got to zero out that account. And then the opposite would be if you are decreasing your cost of goods sold with a credit, then you would go ahead and debit your manufacturing overhead to zero out that account.